Everyone says you need thousands of dollars to start investing. They say you need a financial advisor, a complicated portfolio, and years of experience. But what if that's completely wrong? What if the only thing you needed was just $100? Not $10,000. Not even $1,000. Just one single Benjamin. Maybe it's money from a birthday gift. Maybe it's extra cash from a side hustle. Maybe you sold something online. Or maybe you simply skipped eating out this week and saved $100. Now you're staring at that $100 and wondering, do I invest it? Do I save it? Do I flip it? Or is it even worth doing anything at all? Most people do nothing. They think $100 is too small to matter. So they spend it, and the opportunity disappears. But here's what experienced investors understand. Your first $100 is more important than your first $10,000. Because the first $100 builds something deeper. The habit, the mindset, the confidence, and most importantly, momentum. And once momentum starts, money begins to grow. This is where compound growth comes in. When you invest $100, you don't just earn returns on your money. You begin earning returns on those returns. That means your money starts working, and then your money's growth starts working too. Think of it like planting a seed. At first, nothing seems to happen. Then a small sprout appears. Then branches. And over time, you have something much bigger than what you started with. Here's a simple example. Let's say you invest $100 and add just $10 per week. At an average return of around 8%, in 1 year, you're around $700. In 2 years, you're over $1,500. In 5 years, you're approaching $4,000. That's not luck. That's not timing. That's consistency. And today, you don't need to be wealthy to start. You can buy small pieces of stocks. You can invest in many companies at once. You can even invest spare change automatically, all starting with just $100. So the real question isn't, can you start? It's where to begin. In this video, you'll see 6 practical ways to turn $100 into $1,000. Simple approaches, clear steps, no unnecessary risk. And by the end, you'll know exactly what to do with your first $100. Because the hardest part isn't growing money. It's starting. Let's start with one of the most powerful tools beginners have in 2026. Fractional shares. Not long ago, if you wanted to invest in companies like Amazon, Apple, or Microsoft, you had to buy a full share. And that could cost hundreds or even thousands of dollars. So small investors were locked out. But fractional shares changed everything. Now, instead of buying one full share, you can buy a slice of a company. That means your $100 can be spread across multiple businesses instantly. Think of it like this: buying slices of pizza instead of the whole pie. You don't need $3,000 to invest in a high-quality stock. You can invest $10, $20, even $5. That means your first $100 can look like this: $25 in a tech company, $25 in a consumer brand, $25 in healthcare, $25 in energy, Now, instead of betting on one company, you're diversified. This reduces risk and increases your chances of steady growth. And here's where things get interesting. Let's say your $100 portfolio grows at an average of 8% per year. That's not aggressive. That's historically reasonable. After 1 year, about $108. But now, you add just $20 per month. After 12 months, $100 starting, plus $240 contributions, plus growth. You're now around $360 to $380. Now the snowball starts forming. Because you're not just investing once, you're building ownership every month. And psychologically, this is huge. When you own pieces of companies, you start thinking differently. You stop being just a consumer and become an owner. You don't just buy from companies, you invest in them. And here's something beginners often miss. You don't need to pick the perfect stock. The goal at this stage is participation, not perfection. Start simple. Stick to companies you understand. Focus on long-term growth. Another benefit of fractional shares is automatic investing. Many brokerages now let you schedule contributions. $10 every week, $25 every month, or even invest spare cash automatically. That means your $100 doesn't stay stuck. It keeps growing. And over time, this consistency is what pushes you toward that $1,000 goal. Because if your initial $100 becomes $120, then $120 becomes $200, then $200 becomes $350. You're already halfway there. Fractional shares remove the biggest excuse. I don't have enough money to invest. Now you do. And your first $100 becomes your first step toward real ownership. If fractional shares are about owning pieces of companies, ETFs are about owning entire markets in a single click. ETF stands for Exchange Traded Fund. But don't let the name sound complicated. The idea is simple. An ETF is a basket of investments. Instead of buying one company, you're buying hundreds at once. Imagine walking into a grocery store with $100. You could buy one item, or you could walk out with a full basket with food from every category. That's exactly what ETFs do. Your $100 instantly spreads across tech, healthcare, finance, consumer goods, and more. And this matters because diversification reduces risk. If one company struggles, others can balance it out. That creates smoother, more consistent growth over time. And that's why ETFs are often the starting point for long-term investors. Now, let's look at the numbers. Let's say you invest your $100 into a broad market ETF. Historically, many diversified ETFs return around 7% to 10% per year over the long term. So your $100 alone won't become $1,000 overnight. But consistency changes everything. Add just $45 per month. That could come from small changes, like fewer subscriptions, less eating out, or spare cash. Here's what happens. Starting, $100. Monthly, $45. Return, 8% average. After 12 months, around $700. After 16 to 18 months, around $1,000. That's the bridge. Not luck, not trading, just steady investing. And here's another advantage. ETFs remove decision fatigue. You don't need to research dozens of companies. You don't need to follow earnings reports. You don't need to constantly adjust. You simply invest and let the market work. This is why many investors call ETFs set it and forget it investing. Buy consistently, hold long term, Ignore short-term noise. But about that noise, the market will go down sometimes. Your $100 might become $95, then $90, and then recover. This is normal. Short-term volatility is the price of long-term growth. Beginners panic here. Experienced investors stay calm. Because over time, markets tend to move upward. So when your ETF dips, don't think, I lost money. Think, I'm buying the market on sale. That small shift in thinking changes everything. Another advantage in 2026 is accessibility. Many brokerages now offer zero account minimums, commission-free trades, fractional ETF investing, automatic deposits, meaning your $100 can start working immediately. And once your ETF begins compounding, your path to $1,000 becomes clear, slow, steady, and realistic. Now, let's talk about one of the easiest and most underrated ways to turn $100 into $1,000. Micro-investing apps. This is where investing becomes almost automatic. Instead of trying to invest manually every week, these apps do the work in the background. Here's how it works. You connect your debit card. Then, every time you buy something, coffee, groceries, gas, the app rounds up your purchase. Spend $3.50, it rounds to $4. That extra 50 cents gets invested automatically. It sounds small, but this is where consistency eats size. Let's say you average 5 roundups per day. That's about $2 daily, around $60 per month, plus your initial $100. Now, you're investing without even thinking. If that money grows at around 7 to 8% annually, here's what happens. Starting, $100. Monthly roundups, $60. Average return, 8%. After 12 months, around $900. After 14 to 16 months, roughly $1,000. And you barely felt it happen. This is why micro-investing works. It removes friction. You don't need discipline every week.
You don't need timing. You don't need stock picking. You just live your life, and investing happens quietly. This also solves a major beginner problem, forgetting to invest. Most people start motivated, then life gets busy. Weeks pass, months pass, nothing happens. Micro-investing fixes that. Your money moves even when you don't. Another benefit is psychological. Because you're investing tiny amounts, market drops feel less scary. If your portfolio drops 5%, it's just a few dollars, so you don't panic. And staying calm is what allows compounding to work. Many micro-investing apps also diversify your money automatically. Instead of picking stocks, your funds are spread across ETFs or index funds. That means your spare change is building a real portfolio. Now, combine this with your original $100. That $100 becomes the seed. Roundups become the water. Time becomes the sunlight. And slowly, the portfolio grows. You check your account and see $200, $350, $600, $1,000. And you didn't need a huge income to do it. Just small, consistent contributions. One more tip. Many apps also allow recurring deposits. Even adding $5 per week can speed things up significantly. Because the goal isn't flipping $100 overnight. The goal is using $100 to start the engine. And once that engine is running, reaching $1,000 becomes much easier. Now, maybe you're thinking, this sounds great, but what if I don't want to risk my $100 in the market? That's completely fair. Not everyone is comfortable with volatility, especially when starting out. And that's where high-yield savings accounts, or HYSAs, come in. This is one of the safest ways to grow your first $100 while still earning something meaningful. Here's the difference. A traditional savings account might pay around 0.01% interest. That means your $100 barely grows at all. But high-yield savings accounts often offer around 3% to 5%, or more, depending on rates. That may not sound huge, but it's a meaningful step up for short-term growth. More importantly, your money stays safe, liquid, accessible, and protected from market swings. And that makes this method ideal for building confidence. Now, let's connect this to your $1,000 goal. Let's say you deposit your $100 into a high-yield savings account, earning 4%. Then you add $50 per month. Here's what happens. Starting, $100. Monthly, $50. Interest, 4%. After 12 months, around $715. After 16 months, about $1,000. No volatility, no market swings, just steady, predictable growth. This method is slower than investing, but it's more stable. And for many people, that stability is what helps them begin. Because the biggest risk isn't losing money. It's never starting at all. Another smart way to use this is as a launch pad. You build your first $500, then your first $1,000, then move part of it into investments. This creates a simple system. Savings for stability. Investing for growth. This is how many long-term investors manage risk over time. There's also a psychological benefit. When your savings grow consistently, you feel progress. You feel momentum. You start adding more. You spend more intentionally. You begin thinking long-term. And that's when your first $100 becomes part of something bigger. Also, many high-yield savings accounts today offer no minimum balance, no monthly fees, automatic transfers, daily compounding, which makes them very beginner-friendly. So if you prefer safety or you're just getting started, this is a completely valid path from $100 to $1,000. It may not feel exciting, but it is reliable. And sometimes, slow and steady is exactly what builds real wealth. If ETFs are baskets of investments, index funds are the autopilot version of long-term wealth building. This is one of the simplest and most reliable ways to turn $100 into $1,000. An index fund tracks an entire market. Instead of trying to beat the market, you become the market. For example, some index funds track hundreds of large companies. So when the overall economy grows, your investment grows too. This is why index funds are often recommended for beginners. They're diversified, low cost, passive, and historically consistent over long periods. Now here's why this matters for your $100. When you invest in one stock, you're relying on one company. But with an index fund, you're relying on the growth of the entire economy. That reduces risk significantly. And because index funds are passive, their fees are usually very low. Lower fees means more of your money stays invested and compounds over time. Now let's look at realistic numbers. Starting, $100. Weekly contribution, $10. Average return, 8%. After 12 months, around $660. After 18 months, around $1,050. There's your $1,000. And notice what you didn't have to do.
You didn't trade. You didn't time the market. You didn't research every day. You just invested. Consistently. This is why index funds are often called boring but powerful. They don't grow overnight. They grow quietly. And that quiet growth is what builds real wealth. Now let's talk about something important. Index funds will go up and down, just like the market. Your $100 might drop to $92, then $88, then recover. This is normal. The mistake beginners make is stopping when the market dips. But long-term investors do the opposite. They keep investing. Because when prices drop, you're buying more shares for less money. And over time, this actually accelerates growth. This approach is called dollar cost averaging. You invest the same amount on a regular schedule, regardless of price. And over time, this smooths out volatility. Another benefit? Index funds require very little maintenance. You can automate. $10 per week. $25 per month. Or invest extra income. Then, let time do the work. Your first $100 begins to grow. $150, $300, $600, $1,000. And it doesn't stop there. Because once you reach 1,000, compounding becomes even more powerful. The hardest milestone isn't 10,000. It's the first 1,000. And index funds are one of the simplest ways to get there. Now we're stepping into one of the most powerful and often overlooked strategies for turning $100 into something much bigger. The Roth IRA. This isn't just an investment account, it's a tax strategy. And over time, taxes quietly reduce a lot of investment growth. Here's how a Roth IRA works, in simple terms. You invest money that's already been taxed, but from that point forward, your money grows tax-free. And when you withdraw it in the future, you pay zero taxes. Not on your contributions, not on your gains, nothing. Think about that for a moment. If your $100 becomes $1,000, you keep the full $1,000. If it becomes $10,000, you keep the full $10,000. That's the power of tax-free growth. Now, here's why this matters for beginners. Many people wait to invest because they think, I'll start when I have more. But with a Roth IRA, starting small is actually an advantage because time matters more than amount. Let's walk through a simple example. You start with $100, then add $50 per month, and invest in something simple, like an index fund averaging around 8%. After 12 months, around $750. After 18 months, around $1,100. There's your first $1,000. But here's where it becomes more powerful. If you continue for several years, that tax-free compounding begins to accelerate.
And because there are no taxes on gains, your money isn't reduced along the way, which means it compounds faster than in a taxable account. Now, let's talk about flexibility. You can withdraw your original contributions anytime, without penalty. So if you've invested $500 total, you can access that $500 if needed. That makes this less intimidating, especially for beginners. You're not locking your money away forever. Another advantage, you choose what to invest in inside the Roth IRA. That means you can combine this with index funds, ETFs, even fractional shares. So instead of picking one method, you can stack them together. And that's how long-term wealth is built. Now, a quick reality check. There are annual contribution limits, and you need earned income to contribute. But for most beginners, this isn't a barrier, because we're starting small anyway. Also, many modern brokerages offer zero minimums, no account fees, commission-free investing, which makes getting started simple. And here's the bigger shift to understand. A Roth IRA isn't just about turning $100 into $1,000. It's about turning small, consistent investments into long-term, tax-free wealth. Because once you reach $1,000, then $2,000, then $5,000, you're no longer just saving money. You're building a system. And that system keeps working for you, quietly, consistently, and efficiently. At the beginning of this video, we talked about $100, just one single bill, something most people would spend without thinking. But now, you see it differently. Because that $100 isn't small. It's a starting point. It's the moment where things can begin to change. Because the truth is, there's no perfect method. Fractional shares work. ETFs work. Micro-investing works. High-yield savings accounts work. Index funds work. Roth IRAs work. They all work, but only if you do. And that's the difference. Most people wait. They wait for more money. They wait for the perfect time. They wait until they feel ready. And while they're waiting, time keeps moving. Years pass. Opportunities fade. And that $100 gets spent instead of invested. But the people who build wealth, they start before they feel ready. They take that first step. They invest that first $100. And then they keep going. $10 a week, $50 a month, small amounts, consistently. And over time, that consistency becomes momentum. That momentum becomes growth. And that growth creates freedom. Now, one quick reminder before you go all in. If you have high interest debt, focus on paying that down first. If you don't have an emergency fund, build that safety net. Because strong finances are built on stability first, then growth. But once that foundation is in place, you can move forward with confidence. Your first $100 can become $200, then $500, then $1,000. And beyond that, it keeps going. Because compounding doesn't slow down, it accelerates over time. So here's the real question. What will you do with your first $100? Spend it or start something? Because the hardest part isn't turning $100 into $1,000. It's making the decision to begin.